Hi, my name is David Hawa, Client Portfolio Manager at Robeco. I'd like to share with you our credit outlook going forward. Let's start with government bond markets. Why government bond markets when we're talking about the credit markets? After all, if you look at your yield component, that has been the largest contributions to yield in any of the credit strategies. So, looking at the US Treasury market to begin with, we've seen a lot of volatility. 10-year US Treasury went up to 5%, and currently they come back down to around 4.5%. So we've seen yields come back down again. In similar move in November, where we've seen 10-year German government bonds, they went up to 3%, and currently they're around about the 2.5, 2.6%. So again, yields of November have come back down again. So what is this telling us? Our view, this move is telling us that central banks have done most of their work to control inflation. And currently, and we've seen the language coming through, is they are assessing higher interest rates on the real economy. So we do believe that central banks will pause for the time being, and we will see at the next FOMC meeting and the ECB meetings the probability that they will not hike rates, or at least they will want to assess the impact of higher rates on the economy. Looking at inflation, we do believe that this is coming under control and that figures do not surprise. And if we do see figures do not control on the upside, we do believe that the possibility even of rate hikes in the second half of 2024 is very much real. So why is this all important? We're talking about the credit markets after all. Well, for a start, as a fixed income allocation, you're looking at your yield and your yield contribution. Our view is that at these yield levels, they are very interesting. And as a fixed income investor, you want to lock into these yield levels. So we do believe these yield levels are looking extremely interesting. And this is historically, they've been and have been at quite the high levels. They're coming down. We do believe these could plateau at these levels, or they could even come down even further. So time to look into your fixed income allocation, perhaps look to get exposure to those yield levels. How does this all fit into the credit markets? Well, for a start, you're earning extra spreads. And we do believe as an investment into investment grade, you are being rewarded and even well rewarded for the risk that you're taking on. If you look at specific sectors, for example, look at the financial sector, we do believe in Europe, you're being well rewarded, and it ticks both the fundamental and the valuation box. The fundamentals, if we look at balance sheets of banks, we do believe that the ECB has done a lot of work in terms of regulations that have set up for over 10 years ago. In terms of valuation, we do believe that that is a sweet spot. European banks is a sweet spot for valuation within the credit markets. So it ticks both boxes. And we are looking both at issues, both on senior level and subordinated levels. Remember, for strong financial institutions. The second reason that looking at the credit market is income. At current yield levels, we do believe that you're getting a nice steady income because yield levels can provide that. Remember, a few years ago, yield levels for government bonds were very low levels. And even in Germany, they were at negative yield levels. So how could this provide an income for you? So we do believe currently these are very interesting yield levels to enter to provide a good steady income. Furthermore, an unconstrained approach in a strategy will provide even more returns. So we do believe that volatility could increase in the credit markets. And so therefore discrepancy, it creates investment opportunities between investment grade, high yield, and emerging markets, therefore creating more returns, therefore the potential of a higher income. Finally, sustainability. Why should I care? We do believe that sustainability, apart from the feel-good factor, does make economical sense. Do you want to invest in companies that have controversies, that have been involved in bribery, that have no plan for CO2 emissions? Our view is that by doing your screening, this makes economic sense in the medium to long term to invest in solid companies that are making those dynamic changes in a dynamic environment that is actually now demanding more sustainability. So, summing up going forward, what are we looking for in 2024? We do believe that current yield levels are very interesting and that central banks have done most of the work. So this would indicate that current yield levels are stabilizing and could even come down. So time to lock into those higher yield levels. On terms of the credit markets, we do believe currently that investment grade credits are really offering a good risk reward profile. For income, we do believe, like I said, in terms of yield levels, we are currently in a very interesting time to create that very interesting income levels, and having an unconstrained approach is the right way to create those income streams. If you found this interesting and you want more information, please feel free to contact us. Thank you very much for listening.